A very warm welcome to the Icosa cat bond market update and outlook. My name is Wolfgang Made, and I'm pleased to welcome you to this 30-minute webinar. And Florian Steiger from Icosa will provide us with a market overview, review of the most recent developments, and also with an outlook for the cat bond market in this 30-minute time slot. A few housekeeping notes. This is a webinar that is exclusively for professional investors and is only directed at them. And please feel free to submit your questions anonymously via the chat function in the bottom right corner of your browser. So we will collect these questions and then go through them one by one. Yeah, and in order to make best use of our time, Florian, over to you.
Well, thank you, Wolfgang, and good morning also from my side, and great to have so many of you dialing in to discuss the latest in the cat bond market. And as Wolfgang said, let's make this interactive, so please use the chat functionality, or also if you have, or the question functionality, I should say, or also if you have any questions which are not addressed on the webinar, feel free to reach out to us afterwards, and we are more than happy to answer them in a one-on-one. Yeah, what I would like to do today is to do three things, really. I would like to do like a top-down overview on where the cat bond market stands, how performance has evolved over the past 12 months. Then I would like to briefly recap the hurricane season, what happened, or rather what didn't happen this year. And then also, last but not least, discuss the outlook for 2026. And there are some structural breaks in the cat bond market which I find quite interesting and which will also have an implication in portfolio construction going forward. Yeah, so let's kick it off by looking at cat bond performance. So what we have here is a chart of the past 20-year plus as measured by the Swiss Re Cat Bond Index. So this is a very long-term perspective of what the market has done and how it compares to more traditional asset classes, equity, bonds, be it investment grade, be it high yield. And what you can see is a very clear picture. Cat bonds have worked remarkably well over 20 years. They had very little volatility, but then, of course, here and then, if there's a big event, you see a certain gap and a certain correction of the market, followed by a steep increase. 2025 was no exception to this. It was a very calm year, I would say. We had a bit of volatility at the very beginning of 2025 with the wildfires in California. You can see it slightly in the chart. There was like a little bit of a correction, like 1 to 2% in January, February 2025. But then everything that happened thereafter was just almost a straight line up. And of course, what is quite interesting, and you see it here for the equity market, all the volatility or the geopolitically induced volatility with the trade wars, tweets, tariffs, yes, no, how high, etc., it didn't really affect cat bonds. So cat bonds this year have done exactly what they are supposed to do. They're supposed to be a diversifier, and if no major events are happening, it's supposed to be a very boring diversifier. And I think except for maybe one or two instances this year, one being the wildfires, second one being the Jamaica hurricane, cat bonds have lived up to the promise of being very robust, well yielding, but also, I would say, very quiet diversifiers, which can play an important role in a multi-asset portfolio. Yeah, what is quite interesting, and it's often something that comes up in investor discussion, is the question of how risky are cat bonds truly? Because you're not getting such a high return for taking no risk. I think that is clear. And when we look at the past 20 years of cat bond history, it becomes very evident why the risk premium is exactly that, a risk premium. And typically, you don't see a lot of volatility and not even a lot of drawdowns. You do see sharp corrections when there is an event, like the Japanese earthquake, Hurricane Katrina, the hurricanes in 2017 or 2022, which is then followed by a steep recovery. And if you compare that to investment-grade corporate bonds, which is what the light blue line here is showing, it's very interesting to see that investment-grade corporate bonds had more frequent drawdowns and also larger drawdowns in the past 20 years. And right now, they're still in drawdown from the increase in interest rates after 2022, whereas cat bonds have more than recovered their 2022 loss after Hurricane Ian, and are trading close to an all-time high for the Swiss Re Cat Bond Index, which is a performance index. So yes, it's a risky asset class, of course. You're not getting risk premium for nothing, but over the past 20 years, cat bonds have held up remarkably well, even compared to an asset class like investment grade rated corporate bonds, which most people would typically perceive as being quite safe. Yeah, how did we do in the fund? Makes me very proud to say that the fund, despite all the issues that come with the ramp up, cash drag, constantly buying bonds in primary and secondary markets, the fund has done very, very well. We've even managed to outperform the Eureka Hedge ILS Advisors Index, as shown here on the left-hand side. And that's index which even includes higher risk, higher return private ILS funds. So that certainly was a very good outcome of the first 1.5 years in our strategy. What is interesting to see is a little dip we see in the beginning of 2025. These were the wildfires. And as you can see, the fund was essentially not affected by the wildfires. We hardly had any exposure there because we believed back in the time, 1 year ago, that wildfire risk was not adequately priced. And hence the premium one could collect for assuming that risk was not attractive enough to do it. That view, by the way, has changed slightly now after the events. Premiums are much higher, but I'm going to touch on that point a bit later on. What is also important to note is the chart on the right-hand side comparing our risk level to that of the market. So as you see, the market has a risk level of roughly 2.0, 2.1% expected loss. And our fund, after the initial fluctuations with like inflows ramping, it hovered around, I would say, 1.5, 1.6%. So that's 25, 30% less risk than the market. And yet we were able to have a performance which was very strong. And on a risk-adjusted basis, if you were to account for that we have like a third less risk than the market, I would certainly argue that the concept is working. We don't want to be the best performing fund in a good year by simply taking more risk. I mean, that's like doing a skiing racing downhill and then the guy who puts more weight on wins if they just go straight. But if you get the slightest bump, it might derail you and you fall. You have a crash. That's exactly what we want to avoid here. We want to achieve an outperformance over the reinsurance cycle by making sure the fund is managed in a way that we can exploit opportunities when they are presented. Like wildfires, we are not invested back then. We might be doing a little more now. The index-linked trade in the second quarter of 2024, where we are able to identify a huge mispricing in the entire segment. These are the things which should be driving outperformance. It should not be a function of simply taking more risk. But of course, in a year where essentially nothing happens, and we've seen some funds which had risk levels or investment degrees in the high 90%. That's not what we do here. I think that's very dangerous. It works until it doesn't, because liquidity is always the Achilles heel of any fixed income strategy. It's not what we do. We are conservative there, but we try to be selective in our positioning. And as shown, this has worked very well over the past 1.5 years. And that's, of course, something which we are very proud of. Yeah, so the hurricane season 2025, it was rather uneventful, I would say, at least on the top level from insured loss perspective. But what most people conveniently forget rather quickly is that from an event perspective, so not from insured loss perspective, but from things happening, it was actually record-breaking in many ways. We had 3 Category 5 hurricanes. That's a lot. This has only happened once before in 2005, where we had Katrina and Wilma as very destructive hurricanes. I mean, New Orleans was gone essentially afterward. And 2005 was also one of the worst possible years for the cat bond market. And this year, at the start of the year, with exactly the same, I would say, climatological conditions, which led a lot of forecasters to believe like this might be 2005-like. And in fact, 2025 was 2005-like, with a single exception that the hurricanes, due to steering currents, they curved and they didn't hit US mainland. And that's the only reason why we're now talking about a rather uneventful hurricane season instead of hurricane season with 150, 200 billion of losses. And for one of these hurricanes, the one which then curved just off the coast of Florida, the purple one, that was a Cat 5, there were projections of that one making landfall in Miami as a major hurricane. And if that would have happened, of course, the more conservative positioning this year would have paid off many times over, and we wouldn't even be discussing track record anymore. Unfortunately, it didn't happen. We had a good year, and the only hurricane which caused some sort of damage was Hurricane Melissa just a couple of weeks ago, which impacted Jamaica. Melissa was interesting for many reasons. It had a very low central pressure of 892 hectopascal or millibar, which is, I'm not sure if it's record breaking, but it's close to record breaking. I think there was one which had slightly lower central pressure of like 888, 889 millibars, but this is pretty much as strong as it's physically possible on the planet Earth to get there. I think if you go to planet Jupiter, there might be storms which have higher intensity, but on Earth, the friction in the atmosphere basically blocks storms from from reaching much larger wind speeds. And wind speeds reached 300 kilometers per hour, sustained wind speed, not gust, sustained over 3 minutes. And I keep saying it, if you ever drive to Germany, you rent out a fast car, stick your head out of the window at 200 kilometers per hour and see how that feels. And the force of wind goes up in an exponential way. So 300 is not just a third more, it's much, much stronger. And of course, the devastation that is caused by these wind speeds can be quite extraordinary. What you see here on the map is basically these numbers in white, they show you return periods, i.e. how often these wind speeds are reached. And right where Melissa made landfall, you see 4,000. That means these wind speeds in that location are only expected once every 4,000 years. That is rare. I mean, 4,000 years ago, we had, I think the Egyptians were about to build the Great Pyramids. So that's the return period we are talking about here. So a very extreme event. Fortunately, where you see the 10, that's Kingston, the capital of Jamaica, their wind speeds were much, much lower. So the gradient of wind speeds, which is also remarkable, was very steep. And that's the only reason why there's no major humanitarian disaster on Jamaica, because the most densely populated areas, they didn't see these super high wind speeds. Still, there was loss of life. There was significant loss of property. And also one parametric cat bond sponsored by the World Bank defaulted. It was $150 million notional, roughly 28 basis points market weight, slightly less than our fund. And that one has already paid out. The money was sent to Jamaica, and it's already making a difference on the ground. I think, yes, it's a loss for investors, a small one, I would say, especially in the context of this year, but it can make a huge difference for the people on Jamaica, for the communities there. And it's the reason why the cat bond market really is a win-win. In a good year, there's a good return. If there is an event, the money is not gone. It goes somewhere else. In this case, it goes to people who have to rebuild their lives after catastrophe. So hopefully that makes even a small loss a bit easier to stomach. The hurricane season runs for 12 more days. The forecast models don't show anything on the water. So I think it's never 100%, but it's almost safe to say for this year, the hurricane season, we can probably close the books up on. Yeah. So what do we expect for next year? And what is interesting is that the cat bond market is still offering a much high yield compared to investment grade bonds, of course, but even compared to equities. If you just take the reciprocal value of the PE of the S&P 500, you see that the cat bond asset class still is offering a very compelling rate of return, despite the fact that it's completely diversifying and it's a natural diversifier. And that's also a reason why we see more inflows into the asset class, which now need to be invested over the next half year. Fortunately, the cat bond market is growing, and it's growing at a rate which we have not seen for quite some time. So we see it here where we compare primary market issuance volumes year to date compared to the past 5 years. And already now in mid-November, with more than 20 billion of year-to-date issuance, this is a new record high. And the brokers have more bonds to issue until the end of the year. So we will probably end the year at like 22, 23 billion of issuance, which then helps the market also to grow in absolute size. So I wouldn't be surprised to see a 60, maybe 65 billion by the end of next year. For us, that's always great as portfolio managers, because we can decide where to deploy capital. And if the menu gets larger, it means we have a bigger selection to choose from. And it also gives us a bigger freedom to say no to certain risks, as we have alternatives to what we can buy. So that certainly is a very, very positive development for investors to see this amount of new issuance coming to the market. And apparently the world is not running out of risk which is needing reinsurance, and the cat bond market is there to take on these risks. Yeah, same can be said about the secondary market. So to the left, we see our internal estimate of secondary market trading volumes. What's interesting is there was a spike in Q2 this year. That was mainly due to the fact that there was a portfolio manager shift at one of the larger other funds out there in the market, where one portfolio management company was replaced with the other. And as a result, a lot of investors also either redeemed or they switched to the other fund. And a few bonds actually came into the secondary market as a result of that. And that, of course, then resulted in higher than usual trading volume. For most months, I would say trading volume was between 200 million to 500 million ballpark. So still good enough to deploy some capital, but it certainly would not have been enough for us to ramp the fund in the hurricane season. And that's one of the reasons why we need to be very strict on new inflows, and why we needed to put restrictions on that. Yeah. What we also compare always to get a feeling of the pulse of the secondary market, also looks a bit like an EKG chart here to the right, is we compare broker valuation prices to transaction prices. So if a broker has a bond marked at 101, but it's trading at 103, it would show at 2 points above. And as you can see here, especially in the hurricane season, most transactions in the secondary market by market participants, so it's not our trades, it's trades which we find on Trace, they happened above valuation price. I.e., people overpaid relative to the broker indications. And that's, of course, a function of liquidity coming to the market. And it's the very reason why we have decided last year and this year to limit inflows in the hurricane season. Because if you want to deploy them, it comes at a cost. So we believe it's much smarter to wait until the end of the hurricane season, like right now, then collect the inflows, ideally as quickly as possible, because then you have half a year to deploy it. And you don't end up having to deploy it in the secondary market, where you might not have the full choice available. And importantly, it also might be more expensive to deploy capital in the secondary market. Yeah, now we are in the middle of November, and what we always do, of course, when we transact in a cat bond, we cannot take the expected loss as static, because depending where you are in the year, a hurricane exposed cat bond has a very different annualized expected loss. And right now, roughly almost a third of the market is in bonds which expire before the next year's hurricane season. And of course, a hurricane bond which expires and matures before next year's hurricane season is essentially risk-free. It's very rare to see a hurricane that could cause significant damage until May or June next year. And hence, when you look at the market's dynamic seasonality adjusted expected loss, you always see this pattern. And November, December is always the time when risk is the lowest. So it's a good time to enter if you're new into the asset class, because at least for the next 6 months, the chances of a major loss are quite a bit smaller than they are in mid-August, for example. And so from that perspective, this now is really the calm period of the year. But of course, it never is fully risk-free. Earthquakes can happen year-round. Wildfires can happen in January, as we have seen. And then in Q2, of course, we get the tornado and hailstorm season in the US. But at least for now, we are probably rock bottom when it comes to the seasonality adjusted risk numbers. Yeah, one interesting, almost a structural shift in the market, and is what we are seeing here. That is the spread of peak risks versus non-peak risk relative to the market. So the way you read this is like the dark blue line, that's peak risk, hurricanes and earthquakes. And these bonds always used to pay like 1% more than the market average. Diversifiers, basically everything else, they used to pay roughly 2% less. And for the second time now in 1 year, at the same end of last year, but now we have it again, these lines are crossing, meaning that diversifying bonds pay as much as peak bonds. Now, in the past, and many of you have known me for quite a few years, we've always favored the peak risks for 2 reasons. It tends to be better modeled, and also it was simply paying significantly more. 2 things have changed. One is what we see here. The paying more that gap has widened. It will probably gap again a bit more if all the hurricane bonds, which are not yielding anything anymore because they run off, are out. So some of it is temporary. Because as you see, last year in November, we had the same picture, but it never had happened before. So there is a structural shift in the price of these risks. And the second factor that has happened is the models got updated on the secondary perils. So AR Verisk, for example, they updated their convective storm model this year. The wildfire models have been updated. So the risk numbers presented on these diversifying perils, they're much more conservative now. So both arguments, the difference in modeling quality and the difference in pricing, that has narrowed. And for that reason, we believe now that this is a good reason to rethink portfolio allocation. And if before concentration was primarily on the peak risks, that will still stay the same because simply that is the majority of the cat bond market. But at least adding a little bit more diversification certainly does make sense. And that is something, if the primary market also gives us the opportunity, that is something which will be reflected in the portfolio for 2026. For investors, that is excellent news because what it means, it means more diversification within the diversifier. It means less reliance on your hurricane risk. It means a bit more robustness on the portfolio overall, simply because there's more risk to choose from, and hopefully then also a bit more stability if we should ever get the big drawdowns from peak events like a Miami hurricane or California earthquake. So certainly welcome news, but an interesting shift in the market, which we're now seeing for the second time. And I think that's something which in portfolio construction, you can simply not ignore. This is too big of a shift. It's a huge shift for the cat bond market, and hence it will be reflected in the portfolio. Yeah, maybe one update on parametric bonds. We briefly discussed the Jamaica situation. That was a parametric bond. And you might recall that this is a topic which we had flagged also prior to the hurricane season in Q1 this year, where we've run analysis on historic losses compared to notional issued per trigger type. That's the chart on the right. And it already looked, I would say, very interesting back then. Parametric was already the highest losing trigger type relative to notional issued back then. And now $150 million later with the IBA Jamaica, this has even widened the gap further. So if somebody tells you parametric is the solution to all of ILS's problem, I'd be very skeptical because at least for the cat bond market in the past 20 years, parametric bonds, trigger structures have not worked that well to the benefit of investors. They have been by far the worst performing trigger type we've seen. And there's many reasons why this might be the case. Too much to discuss here, given the short time we have left. But it's just something to keep in mind that one needs to remain very cautious of looking into the structures that one analyzes here. And that's one of the reasons why overall we certainly don't think parametrics should be a major overweight. There's some which are good, there's some which we don't like as much, but it's really a case-by-case discussion that needs to be factored in when making an investment decision. Yeah, last but not least, how will the hurricane season look next year? Honestly, tough to say this long out, but we see two major components shifting in our favor. One is the energy content in the ocean. So we don't only just look at sea surface temperatures. We think that doesn't go literally deep enough, but we need to go deeper and look into the ocean heat content, which involves also the water below the surface temperature. And there we see that compared to the past prior 2 years, we are back to normal, which is great. The past 2 years have been extreme, also resulting in extreme hurricane formation and intensity. And right now we are back to normal. And of course, less energy for hurricanes to form should translate into an improvement in probability distribution of less major hurricanes. The second component, which is one of the most relevant predictors of hurricane intensity, especially of rapid intensification, is the state of ENSO, La Nina versus El Nino. And this year we are in neutral La Nina light conditions, and that means there's less wind shear in the Atlantic. And if there's less wind shear, hurricanes can intensify very rapidly, as we've seen 3 times with the 3 Cat 5 hurricanes this year. And it is expected by most models that this will change for the peak of next year. It will go at least to neutral conditions, and many models even expect the El Nino conditions, which means higher wind shear, which makes it so much harder for hurricanes to intensify. And combined for those two, if that were truly to happen, again, it's early out, so it's hard to say, but at least it's going into a direction where the outlook for next year might very well be significantly more positive than the outlook we had for this year. And that, of course, is very positive news for investors and should hopefully result also in a very good performance for 2026. Yeah, where are we now? End of November. The hurricane season is almost done, 2 more weeks. But personally, don't expect much more from it based on the forecast we are seeing. We are up to the neck in primary issuances. I think there's like 30 bonds or so being sold right now. We've also had some inflows into the fund, so that's working according to plan to get all the inflows now. So we have half a year to invest it into the issuance which come until the hurricane season, and then most likely in Q2 next year, as we are approaching the end of the issuance window, we have to put in capacity constraints for fund investors going forward to make sure we go into the hurricane season with an optimal portfolio, and that will then of course start in June 2026.
Perfect, Florian. Many thanks. A lot of insightful information that you provided, and also a lot of good messages regarding diversification. Looking into the questions, why has the expected loss trended down in the past years? I think that's maybe referring to the page 14 or something like this.
Yeah, that's a function essentially of here we go. So that's a function of bonds being issued which are slightly safer. Yeah. But it's not a big change, I would say. Yeah, but it's more or less there, maybe between like 2.5% to 3% ballpark. Yeah.
Okay. Then one question regarding Melissa: why are parametric cat bonds so vulnerable?
Yeah, that's a good question, and there's no easy answer, unfortunately. But I would say if you want to game a cat bond as a sponsor, it's probably the easiest to do in a parametric bond, because what the modeling does is they simulate events. Let's just take earthquakes, for example. And if you only have simulated events up to magnitude 6.2, well, then you can simply put a trigger at 6.3 and it doesn't show up under the expected loss. But of course, you still have a certain chance of this being a 6.3. Even if it's only, let's say, 48%, it doesn't show up. But of course, it's still there. I'm not saying this is how it's being done, but it's certainly there are some vulnerabilities to this. And there are parametric cat bonds which we have declined as part of our analysis here, which have an expected loss going forward of like 1%, but then the historic one of like 6.5%. And that's exactly the issue for many of them. But not always. There are parametric cat bonds which are great. There are some which we don't like. But yeah, the devil is always in the detail.
So important to be selective again. So
yeah.
Another question: where do you see the cat bond market in terms of volume in 5 years?
Yeah, 5 years. I would say probably 60. Yeah, it should be more actually. It should be at 75 billion. And that wasn't the question, but in 10 years, I would hope that we might even get to 100 billion, which of course would work wonders for liquidity and also make it much more tradable. So the market is growing. There are more sponsors coming to the market. There's more people living in places where it's dangerous to live. So the need for protection is also larger. And that's the reason why I would expect the market to continue to grow. And it makes sense for all sides. So.
Okay, then question on Japan. How is the cat bond market developing in Japan? Is there also more issuance volume there?
We haven't seen that yet, but that's probably more of a function of the renewal cycle. So Japan typically renews their issuance program in March, April ballpark. So it's not typically done at year end. And I would certainly hope and expect that we got more issuance out of Japan again in Q2 this year, because also it's very good risk. It's very robust. They build so well, like a 6.0 earthquake doesn't do anything. And that's the reason why it's such a good addition also to the portfolio. Yeah. So I expect more of that, but we have to wait until Q2 next year to see.
And then it would also be, again, maybe a good diversifier in the overall
Yes, absolutely.
context. Okay, perfect. So in the interest of time, I would suggest that we follow up on the other questions that came up directly. So many thanks, Florian. This was great.
Thanks to all of you. Thanks for your trust, and hope to see you all in person again soon.
Perfect. Yeah. So the colleagues will follow up. If there are some questions, feel free to reach out. Yeah, so we're looking forward to the next webinar with you, Florian, and with all the participants. So thank you and have a nice day.
Take care. Ciao.